Hello, everybody. Thank you, Jean. My name is Linda Weilert. I've been a reverse mortgage consultant for 17 years. I am based out of San Jose, but I'm actually from the Peninsula. I was born and raised in the Peninsula, and I lived in Millbrae and went to all the Millbrae schools. I went to Taylor, Green Hills, Cappuccino. My sisters went to Mills, so I'm a Peninsula girl. 18 years ago, I got a call from my father who said that he was going to do a reverse mortgage, him and my mom. And I was, what's that? I was a business development manager for a different company for many years prior to this. And we met with an agent like myself, and we met with other family members, and we realized it was a good decision because they either needed to sell and pay the capital gains taxes and come out about $400,000 in equity in Millbrae. They lived on Anita Lane, or they were going to do the reverse mortgage, get their loan paid off, and get a line of credit. 17 years go by. I see how much it helped my parents in this scenario. My father came down with Alzheimer's in 2017, so we used a lot of the line of credit for his care and board and care in San Bruno. And then my mom in 2020, my father has since passed away. My mom in 2020 had a stroke. She was still living in that big house on Anita Lane. She needs full care, the highest level of care, and medication management, help, just help. So we moved her to an assisted living in Sacramento near my sister, and we sold the house. So fast forwarding 17 years, the loan's going to grow over time, right? It has to, because there's interest on the loan and no payments were being made. They had a $200,000 mortgage. They were given $280,000, I believe, in a line of credit. They've used all the money. We used the last $70,000 to update the house. And now the mortgage balance is $800,000. $800,000. So we sold the home for $2.250 on Anita Lane, 558 Anita Lane. And so my mom made out more in equity by doing this mortgage, and it did exactly what it was supposed to do. So just to go over the basics, the HECM is a home equity conversion mortgage. The name was actually changed in the 90s under the Reagan administration from reverse mortgage to HECMs. So the reason is because we all know that reverse mortgages have like a bad history, where it used to be a future shared equity program. Now it's highly regulated, like the VA loan. There is mortgage insurance on this loan. It is an FHA insured loan. And each client borrower is to be counseled by an FHA approved counselor. So there's different processes. So like I said, it is a federally insured loan, and homeowners 62 and older can be a borrower with the situation. We have different ways of applying for this reverse mortgage in terms of the cash that they want up front, a monthly payment to them from the line of credit. They could also use a reverse mortgage for purchase. So if you have an older adult who has a really large home and wants to downsize, but still wants the opportunity to be a homeowner, we could do what's called a reverse purchase, where we put down a certain percentage of the purchase price. The borrower puts down the remaining, and then they can go ahead and hold on to some of the proceeds from the sale of their home for retirement. As you probably know, seniors, the older adults really just want to stay home in the most case. And we're talking about older adults in their 80s and 90s. They really don't want to leave the home that they've raised their children in. And the reverse mortgage offers help in keeping them in their home by paying off their mortgage if they have a mortgage, and possibly getting an additional line of credit, or just providing them a line of credit. They could also supplement their monthly income. I've had a reverse mortgage for a woman who wanted to get away from monthly mortgage payment, and she wanted to hire a gardener. She goes, I can't afford a gardener. So now I want an extra $100 a month so I could have a gardener. The next one is retain more savings for retirement. create a rainy day fund. So a lot of the seniors, older adults, and their children, they have investment portfolios. They don't want to relinquish anything in their investments. They rather use the stranded equity in their home. Buy a new home, like I had previously discussed. They could buy a home with a purchase reverse option. So we have need-based clients. The need-based clients are essentially those who are homebound. They have an illness and they're unable to make their own decisions. So I work with a lot of children facilitating for their parents for in-home care needs, in-home care funding. The children go through all the options and they realize that they don't want to sell the home and help their parents find a retirement facility that could care for them. They rather keep their parents at home where they're comfortable. A lifestyle, live closer to family, no mortgage payments. So lifestyle, this is downsizing, downsizing with still the opportunity to be a home owner and downsize to maybe move closer to family. I'm doing we call it a H4P, a HECM for purchase right now. A gentleman is leaving San Jose, he sold his home. They're in contract and he's buying a home in Sacramento area. And he will be doing a reverse purchase to be closer to his 2 sons and grandchildren. Sometimes the reverse mortgages are used for repairs and for dental payments and so many other things. Now, with planning on a reverse mortgage, it is important that the home is of living use. So no health and safety issues. We need to make sure that 2 straps on the water heater, carbon monoxide detector, smoke detectors are in the home. They will go through a FHA appraisal process. We just need to make sure that the home is in livable standard. There are different ways to obtain a reverse mortgage. So in terms of how the borrower would like their money. So there's line of credits, there's modified term, modified tenure. There's like 6 or 7 different ways that you could take your money. Some people just leave it in a line of credit, take it out as they need it, and they take advantage of the line of credit increase feature that FHA offers, which is wonderful. We're about 7.5%. So if I am able to get a line of credit for somebody who's 80 years old of $350,000, that $350,000 will be worth more to them as they age. So anytime there's a line of credit, that line of credit has an automatic growth, which is a wonderful feature. Modified term is when a client needs a monthly income. So what we do is we give them a monthly income. If they need $8,000 a month for in-home care, we make it for a certain amount of time, and then we also give them a line of credit. So we could go to the next slide because there's so many different ways. And what I do is I sit down with the client and their family, and we form the payment to what their needs are. Using the HECM for purchase, you can purchase a new home with approximately 50% down. Following your down payment and loan closing, you'll have no mortgage payments as long as you live in the home, which is true. It's usually around 50% LTV. Just so you know, the older the client is, the higher the benefit. So if someone who's 62 applies for a reverse purchase, they're not going to get as much in benefit as somebody who's 82 because of the difference of life expectancies. This is not a California market. I'd like to see a $200,000 single family residence living in San Mateo County. But this is a good tool to just use if you have a senior client who wants to sell their home, buy a new home that maybe is single level and not 2 levels, and still be able to have cash from the previous home revenue post escrow. And this is if somebody is downsizing to a less expensive home. So the gentleman that I'm working with, he is in his 70s. He sold his home for $900,000. He's going to be buying a new home for $500,000. We'll give him $250,000 to put down. He will bring $250,000 from the sale of his home. So the HECM for purchase benefits. So one of them is to move closer to family, to go into a single family residence without any stairs, to be able to put additional money in their retirement fund from the sale of their home from their previous home, and no mortgage payments, which gives them more cash flow, obviously, from their income. Borrowers must be 62 and older. We also have jumbo. We have a jumbo reverse mortgage, and the age requirement is 55 and older for the jumbo proprietary. The one where 62 and older is FHA, the Federal Housing Administration. The FHA reverse mortgage is for 62 and above. Our borrowers need to have equity in their home. There's many people I can't help. I would get a scenario where there's somebody 62, inherited a home from their mom, and they owe, 800 on $1 million property. That is just not going to work. However, if somebody who is 62, we would like to at least see 50% equity in the home. The main requirements of the reverse mortgage is that the homeowner and the borrowers must pay their property taxes, homeowners insurance, and HOA dues if that applies.
And Linda, what is the jumbo loan limit?
I just did one for a $6 million home. We lend up to $4 million. Be able to maintain the home, keep it in a livable status. Occupancy is important when it comes to a home equity conversion mortgage. One of the requirements is that you must be on title and it must be your primary residence. If by chance something happens, maybe a health event, and someone breaks a hip and needs to go into a rehab for 9 months, that's fine. They just ask that the loan comes due if the client leaves the home for over 12 months. However, there is not an FHA police officer that shows up to make sure that they're still living in the home. There is a requirement once a year that the borrowers fill out a form stating that they are still in the land of the living and that is still their primary residence. I think I went through the counseling. Every borrower will have to be counseled by an FHA approved counselor, which is a third party, and I have no involvement. I just provide a list. The counseling is typically $135. That's the only out-of-pocket expense to apply for this mortgage. Single family homes, duplexes, triplexes, 2 to 4 units, and condos. We do like the condos to be FHA approved. If they're not, we have a division here at Open Mortgage where we have a condo single unit approval process. So we don't have to really worry about that anymore. But it would be nice if the condominium, if the HOA was FHA approved.
And Linda, this has to do with the property that you're purchasing, right? Not the property that you're
Both.
Oh, both. Okay.
Yeah. When it's due, when the last surviving borrower no longer lives in the home. So when the last surviving borrower passes away and no longer lives in the home, or no longer lives in the home, the loan comes due. The heirs have 6 months to 1 year with 2 3-month extensions, possibly, to either refinance and pay off the loan and retain the home, or sell the home and take the equity that's left over. Okay, so if the borrower fails to pay property taxes, homeowner insurance, or fails to maintain the property, the loan can be forced due. However, they give the homeowner plenty of time with lots of letters and calls to say, hey, you didn't pay your property taxes. You need to pay that, or we're going to have to do a trustee sale and a foreclosure. So it's a notice of default, the NOD. So it's very important. They follow that very closely on all borrowers. Do my children, family members lose their inheritance? In most cases, no. So it depends on how much money the borrowers are using and how fast the home is appreciating. Here in California, I haven't had anybody go upside down. There's always been equity left for the children, just like my mom and dad. My mom walked away richer in equity than when they took out the loan. So in California, that's what we see. So the heirs should be able to achieve an inheritance. If a borrower does have an existing mortgage, We can take a borrower that has an existing mortgage. However, we will be paying off that existing mortgage at a closing. So if they owe $300,000 and their benefit is $500,000, then we pay off the $300,000 and they get a line of credit for $200,000. How much do I qualify for? Depending on the age, the current national lending limit, which today is $1,087,000, and the property value. So someone of 62 is going to get a lot less than somebody who is 82 because of the life expectancy. Will reverse mortgage affect my Social Security or Medicare benefits? No. Medi-Cal, however, we would have to be pretty careful with Medi-Cal. Medi-Cal requires a certain amount of money to be in the checking account and not to exceed that amount monthly. So I just closed 2 loans with people who have Medi-Cal, and they have a trust account. So if you have a trust account under the living trust, that money is not looked at, and we could put the money into that account. Will the bank own my home? No. This is a mortgage just like any other mortgage. On the deed is a mortgage. So I have a Bank of America loan, and that's on my deed of trust that I owe Bank of America. It's going to be the same situation, but with FHA. So the borrower is still on title. The borrower is still the homeowner. The borrower is the boss, and they can make payments on this loan if they want to, but they don't have to. But the bank will never own the home. Now, a common question, what happens if it goes upside down? Which I haven't seen, but let's say the borrower's home is worth $700,000 today, and the balance is $800,000. The heirs just walk away. Do I need to be suffering financial hardship to qualify? No. There's a lot of strategic things you can do with this reverse mortgage, with this HECM. And one of the best features is that line of credit growth. So a younger adult who's 62, who has a paid off home, who wants to plan for their retirement and their future, they are interested in this product. And so is their financial advisor, because of that line of credit increase of 7.5% today. So that line of credit, when they get older, is going to be worth a lot more. Are there any restrictions on how I could spend my loan proceeds? No, there really are not. However, we do counsel ahead of time and through the counseling that the reverse mortgage really has no place for annuities purchasing. So we do discuss why this is the case, because in the history, financial advisors would ask their clients to take out a reverse mortgage, give them the money to invest. So we caught on to that. So in 2014, when the financial assessment came out, we also FHA placed new restrictions that the borrower can only take 60% of the benefit the first year. The remainder comes available on month 13. Lenders pressure seniors to buy products or take advantage of them.
So this is a common misconceptions about that.
Yeah, right. So I think with the history of reverse mortgages, people feel historically that, oh, those reverse mortgages are awful and they're pressuring the seniors and taking advantage of seniors. That is so, so far from the truth. I have seen so many clients, and they are all so happy with their decision and relieved. And when that time comes, when that event happens and they either have to move or they pass away, they usually have plenty of equity in the home to assist them with the next path of choice. But we do counsel. They undergo special counseling. I go through their finances with them. I ask them why they feel that a reverse mortgage is necessary. I have turned a couple people away. And we have to be very careful. Some children who are involved don't have the best motivations for their parent. I can't qualify for a mortgage because of my credit and income. With the reverse mortgage, we have what's called a financial assessment. We need to make sure that our borrower has enough income to pay property taxes and homeowners insurance with the leftover residual income. Our financial assessment is not as stringent as a traditional mortgage. We have a little bit more flexibility. So if somebody has a really low credit score, we look at the whole picture, and we look at extenuating circumstances, and then we go from there and see if we could help them. I will end up owing more than the value of my home. I haven't seen it in California. So I've been doing this for 17 years. And I just have not seen that happen. There's always been equity left over, even for those clients who are taking $12,000 a month for in-home care. If I outlive my life expectancy, the lender will evict me. No, not at all. You're still the owner of your home. You're in a reverse mortgage. You just have to maintain property taxes, homeowners insurance, and HOA dues. So when we begin the process, we begin by education. Sitting down, meeting with me, I present a packet of all the required information to apply for this mortgage. And we go through everything. We go through the numbers, we go through the qualifications. And we sit down and get to know each other and find out what it is that's going to be the best solution for them financially. The next step is the borrowers leave, or I leave their home, and they call to get a counseling appointment with an FHA approved counselor. It's about $135 out of pocket. The next step for me is to compile all the information I need, which is bank statements and IDs and mortgage statements and homeowners insurance. Then we go into the application. After application, we do the appraisal, we do the underwriting, the processing, and then closing. More retirement experts are recommending HECM. So many financial advisors are really surfacing and asking some very critical questions about how they can utilize this reverse mortgage in their client's financial strategy. So it's just been wonderful developing these relationships with these financial advisors and doing all the amortization schedules and different outlooks, and they're really starting to wrap their brain around how, if used strategically, how this can help their client in retirement. It's aging in place. Most folks in their 80s and 90s really just don't want to leave their home where they raised all their children and been living at for 60 years. Plus, you want to avoid any kind of capital gains tax if they're both still living. So, people who in their 60s and 70s, they're a little bit more flexible in, leaving their home and downsizing into something that's easier to manage. Questions?
Can you go through the costs a little bit in terms of what can people
Yes.
expect for costs and rates?
Okay, so the rates are the same as a conventional mortgage. You're talking about high sixes, low sevens. And the cost, if you've heard that the reverse mortgage is expensive, the answer to that question is true. It is true. There's mortgage insurance. The upfront mortgage insurance is what is the highest amount. And for a home that's over $1,087,000, that home is going to endure a $21,000 upfront mortgage insurance. This is a bank, this is a company, this is FHA that is providing access to hundreds of thousands of dollars and no mortgage payment. And they don't know when the loan is going to come due, because we don't know when you're going to pass away. So the average age of these loans, it used to be 8 years. Now the average age of these loans are about 12 years.
Can you go into a little bit? I know I've had this question of how is this different from just taking out a normal HELOC?
So the obvious answer to that initially would be there's no mortgage payment. I do get many calls from seniors like, I tried to get a HELOC and I didn't qualify. All I make is $1,600 in Social Security. I have a paid off home, with all this equity, and it's worth $1.5 million, and I can't get a line of credit. So they come to me, and I'm able to help them in getting a very similar line of credit. When they get a line of credit, they don't get a checkbook, to where they can write checks against. We either schedule ahead of time what they think they're going to want in addition monthly, or we keep it in a line of credit, and then they take it out as they need it by filling out a form and FedExing it in, or faxing it in. Yes.
So what if you own your home and you have a loan on it, and it's a very low interest rate loan, but you don't want to pay that loan off? Can you make the reverse mortgage equity line on top of that, like a second?
So fortunately, one of the proprietary companies came out with something called the Home Safe Second, where you can keep that first mortgage you have and possibly get a line of credit. So it comes down to how much equity is left in the house, what the home is worth, and the age of the borrower. So we do have an option for that. Not an FHA loan. It is a reverse mortgage, but it's a proprietary reverse mortgage.
So let's say you're moving out of state or somewhere and you don't want to sell your house. You're going to keep it, but you don't have all the cash to buy another property somewhere else. Can you get this financing for the new property?
So there's two different ways to do that. You sell your home, you find a property where you're moving, and you do a reverse purchase where the reverse mortgage puts down, let's say 50% of the purchase. Or you do a reverse mortgage on the home that you're currently in, where you get a certain amount of money in most cases, and you could use that money as a down payment to your next home. And then the loan will come due, obviously, when you go to move and sell the home.
So are you saying that you can carry your reverse mortgage forward to the new property?
No, the reverse mortgage will not be transferred to the new property. What I'm saying is that if your client has a home that's worth $1 million and they have no loans on it, and they want to move back east, they need money to get a house out there before they start prepping their house for sale. So we could potentially give them money for a down payment to purchase that house while they're prepping their house for sale. And then once their house is for sale, the reverse mortgage will get paid out of escrow, and then they could go ahead and move. But it won't transfer to the new property. Or they could do what's called a reverse purchase.
And the reverse purchase is if they don't want to. So what if they don't want to sell the home that they had existing?
Well, the reverse purchase will only be on homes that they plan on having as their primary residence. So if they own a home here, they decide to move to Florida and keep their home, maybe rent it, they could certainly do a reverse purchase if they qualify on a new home in Florida. We would just have to source where the funds are coming from on their end.
Would the qualifying be based on traditional standards or on the more lenient reverse mortgage standard?
So the reverse mortgage standard is somewhat more lenient and less stringent than a traditional conventional loan, because we do work with people who have not so good credit or high debt. It really depends on the person. It's a case-by-case basis that will determine if we could really help them. We do have that financial assessment. We do have to make sure that they have enough income to pay their property taxes, homeowners insurance, with a residual income left over. That's after we pull their credit.
So how much do you interact with when you do the counseling? Do you often have the children involved, or do you recommend to have even the children involved in that process? Because they're the ones who might end up dealing with the whole payoff and everything afterward, right? So how does that work?
That's a great question. Some clients don't want their children to know.
Mm-hmm. Oh.
And they're completely of sound mind, and they want to be able to enhance their retirement, enjoy the rest of their lives. And sometimes they just don't want the children to know. We have to honor that. But if there is kind of if there is a situation where I feel that they need some additional help, if they're applying for this loan and they seem, I'm not sure if I should do this, then I usually ask them to bring a child in, or to have their child contact me, or their financial advisor or trusted advisor.
So Linda, maybe you haven't experienced this, but I have a realtor friend who had a listing in San Bruno last year, who they didn't do a preliminary title report on the property and found out later that it did have a reverse mortgage on it. And the reverse mortgage was in excess of the property value. So they couldn't sell the property.
No.
Or a typical listing. So what happens in the case that, in that scenario where the loan is greater than the property value?
George, I'm so sorry, but they still should have been able to sell that property because what is recorded on the deed, this is a really good question. What's recorded on the deed is 1.5 times the property value. Because with the reverse mortgage, we don't know how long the people are going to live, or how long that event's going to happen. They don't know if they're going to live to be 130. So they have to record 1.5 times the property value. So if they pull a title report and they say, wow, they owe $938,000, that is not true. They only owe what the balance of their loan is.
Ooh,
This is a
okay.
common question, and I always try to let realtors know when they are selling a property that has a current reverse mortgage. Don't freak out when you see the prelim, because it's not going to give the amount that they actually owe.
So how would they find out the loan balance? Just have to talk to the lender, get a payoff
Have to
demand?
talk to the client, say, let me see your latest statement, or title could send in for a payoff demand, but yeah, that's like one of the biggest questions that I get from realtors who are selling a home with a home that has a reverse mortgage on it.
What about the client who just lives and lives and lives and they get to over 100 years old?
Mhm.
And their loan amount is growing and growing, and
Mhm.
let's say it possibly is higher than the value of the property. And then they pass away. The is the lending company on the hook for the difference? I mean, is there going to be any deficit? What do they call it?
Any liability on the children or on the heirs? This is a non-recourse loan. That's why the mortgage insurance is so expensive up front.
I see.
It protects the lender, and it also protects the borrower, but more so the lender. So if it goes into a non-recourse situation and it goes upside down, the heirs just walk away. Or they could sell the house within 25% of market value, but they won't get anything back from it. So I would just walk away. So that is called non-recourse. That's what FHA does for us.
What if the owner has other assets, stocks, bonds? Would those be subject to a deficiency judgment? In other words, would the mortgage company who's been, upside down on the loan be able to go after their other assets?
No, absolutely not.
Those are protected.
That's where the non-recourse comes in. They cannot go after any investment portfolio or assets or other properties, Morgan Stanley 401k. They can't go after anything. So they will just sell the house through a trustee sale and take whatever the house is worth and consider that as payoff to the loan.
What happens after the loan goes through? Who administrates the loan?
So I work for a correspondent lender. I work for Open Mortgage. We're one of the top 10 lenders in the United States. I do not work for a direct lender, and I do not work for a broker. Correspondent lenders, we have our own underwriters, we have our own processors. We fund the loan in our name. Then we place it with an investor. An investor buys the loan, and then it goes to a servicer. So the biggest servicer is C-Link. They're one of our servicers for FHA reverse mortgages. And then the client gets a welcome packet from the servicer, and they will service the loan in its entirety.
But thank you very much. I think it's a great tool to have, because and some of you may have noticed Linda was trying to not say seniors too much, because
I know.
I was
Older
telling her
adults.
This morning,
Yeah.
62 doesn't seem that senior anymore.
I
so,
know.
Which is, it's
Next
fine.
year,
It's an
for
accepted
me.
term.
Yep.
Yeah, that people are used to. But I think it's a great option, just your own story in terms of how by using the reverse mortgages wisely, you were able to get your parents into the best situation, and in the end ended with actually more equity than not. If they had sold their home early to make up their expenses, they could have been in a situation where they actually lost out on a bunch of equity and also whatever they wanted to pass on to you as in
Right. Yeah, that's very true, Jean.
Full story.
Yeah, thank you.
Thank you.